Today is a rubber market review. In this session, we have Mr. Jom Jacob, he's a rubber industry analyst, and he'll be speaking about the natural rubber market review. Let me brief you about Mr. Jom Jacob. He has been in the rubber industry for more than 30 years as a global rubber industry analyst and with extensive experience in analyzing the rubber market, forecasting industry trends, and formulating long-term policies and development plans for natural rubber sector. He served the Association of Natural Rubber Producing Countries, shortly called ANRPC, based in Kuala Lumpur, it's a senior economist for 11 years. Before that, he worked for the Rubber Board of India by holding various positions for 23 years. So let's welcome Mr. Jom Jacob to give a report on the natural rubber markets. Mr. Jom.
Hi all. Welcome to the Natural Rubber Market Review, episode number 10. Sentiment in natural rubber markets has been largely dominated by risk and uncertainties arising from the Russia-Ukraine conflict and the potential economic impacts of the massive sanctions announced by the West on Russia. The talk between foreign ministers of the two countries, Russia and Ukraine, helped in easing the geopolitical tension for a few days, but it did not last. Last few days have seen hopes for a ceasefire fading. As a result, crude oil prices again started gaining because the hopes faded for reaching a ceasefire. Another major development last week was the US Federal Reserve raised its short-term benchmark rate by 0.25 or a quarter of a percentage points on last Wednesday, that means March 16. This is the first rate hike by the Federal Reserve since 2018, after 2 years of holding the borrowing cost near zero to protect the economy from the impact of COVID-19 pandemic. Moreover, the Federal Reserve signaled rate hikes in all the 6 meetings of FOMC, Federal Open Market Committee, to be held during this year. Federal is compelled to adopt such an approach because it has to tackle the hottest inflation in 4 decades. A higher interest rate makes borrowing cost higher. Borrowing cost is going to be higher. It is risking economic recovery momentum. So equity markets immediately fell in response to the rate hike announced by the Federal Reserve. However, the Federal Reserve chairman played down the risk of an economic recession and categorically stated that the economy is strong enough to withstand the tighter policy or a bit higher interest rates. So the equity average S&P 500, it closed 2% higher following the statement by the Federal Reserve chairman. That was another major development last week. So these are geopolitical developments and also economic developments. Coming to the NR market fundamental, the world supply of natural rubber remains seasonal low. This is a wintering off-season of supply in major producing countries, especially for the regions falling in the north of the equator. For the south of the equator, wintering season is July, August. So around more than 70% of the global rubber area is in the north of the equator, where wintering season is as of now. However, so the supply is low, but the outlook on the global demand for natural rubber has been weighed down by the potential economic repercussions of the Russia-Ukraine war and the economic sanctions announced by Russia. So we have a tight supply or seasonal low supply. At the same times, because of the war, the outlook on the demand outlook has been weighed down. As we know, natural rubber demand is heavily dependent on the auto sector, automobile industry. The war has aggravated the chip semiconductor shortage. The shortage, in fact, the auto industry was reeling under the semiconductor shortage. So the problem has been aggravated by the war because Ukraine and Russia are dominant suppliers of key metals which are used in chip semiconductors and in the batteries used in electric vehicles. Prices of lithium, nickel, and other raw materials which are key to new energy vehicles, including electrical vehicles, have surged. Moreover, prices are expected to rise further as supplies are disrupted due to the war. So, due to NR's heavy dependence on the auto sector, the continuing Russia-Ukraine tussle can heavily weigh on the global demand prospects for NR. So this is a background. So fundamental supply is tight, but the demand has been weighed down. Outlook on demand has been weighed down by the sanctions as well as the repercussions of the war. So this is a background. With this, keeping this background in mind, let us see how NR prices performed in the last week, both in the futures and physical markets. We have 6 charts to be shown here. First of all, we have the Shanghai futures markets. Rubber futures traded on the Shanghai Futures Exchange. Last week, that is a week from 14 to 18 March, Shanghai rubber futures averaged 3.5% lower, and the average was 13,409 yuan per ton. So it fell compared to a week before. The prices averaged 3.5% lower. Now let us go to the second chart, chart number 2, that is on Cyclone rubber futures. TSR20 is the most popular grade traded on the Cyclone futures exchange, Cyclone exchange. So during the last week, TSR20 futures traded on the Cyclone exchange averaged 4.2% lower compared to a week before. So average during last week was $171.3 per 100 kilogram. Coming to Osaka, where chart number 3, coming to Osaka, the most popular grade is RSS3 futures, RSS3. So in fact, RSS3, it averaged lower compared to 1 week before, but the extent of fall was only 0.7%. And the average was 244.8 yen per kilogram. So this average price was 0.7% lower compared to the previous week, but compared to Shanghai and Cyclone TSR20, the average fall, the fall in the average in the case of RSS3 Osaka was limited because RSS3, the physical market was tight. That could be one reason, and also Osaka market is sensitive to the yen. So yens, depending on the yen's strength against the dollar, Osaka futures can go up and down. So whenever yen is depreciating against dollar, the Osaka futures has a tendency to go up. So this is a reason. One is a dollar, one is the currency factor. The other factor is actually the RSS market remained tight during last week. That also would have helped Osaka futures. So these are the 3 futures market. Now we go into the physical markets. Chart number 4 compares the physical prices of STR20 FOB Bangkok and SMR20 FOB Kuala Lumpur during last week. The blue line shows the STR20. Last week, STR20 at Bangkok averaged 3.9% lower compared to a week before. So average price was $173.7 per 100 kilogram. SMR20 averaged 4.3% lower, and the average price was 171.9. Average 4.3% lower means compared to a week before, average price was 4.3% lower. Now, around 70% of the global trade is in the form of STR or ISNR, which are traded in different names like SMR, STR, or SVR. So this is the most important grade of natural rubber, which is globally traded. Looking into RSS market, physical market, chart number 5, RSS physical market. We have two markets. One is RSS3 at Bangkok and RSS4 at Kottayam. Bangkok market, the price is a FOB price, whereas the RSS4 at Kottayam market is in India. That is not FOB, that is a local price without including taxes or other charges. So interestingly, RSS3 Bangkok averaged 0.8% lower. Means the price fall in the case of RSS was relatively lower compared to that of STR20. So RSS3 Bangkok in the physical market averaged 0.8% lower, and the average price was $219.7, nearly $220 per 100 kilogram. But in sharp contrast to the case of RSS3 in Bangkok, the price of RSS4 at Kottayam, India, averaged 2.6% higher, while all the other market, both futures, physical, everywhere were falling. The RSS4 physical market in Kottayam, India was actually going up went up during the last week. It averaged 2.6% higher compared to a week before. In fact, the higher increase in the price of Kottayam market was driven by a number of factors. One, of course, international price went up over the past 2 or 3 months, or maybe past 6 weeks. International price was going up, so that could be one reason. So the global Q could be one reason. And the second reason, most important reason, is the Indian rupee devalued against the dollar. It sharply devalued against the dollar. So the imported rubber is more expensive. So that means Indian importers or Indian auto tire industry has to pay more rupee to get $1. So Indian rupee devalued. So that means imported items became more expensive. So India is a net importer of natural rubber. Around 40 or 45% of the demand for natural rubber in the country is met by import. So that means imported rubber became more expensive because of the devaluation of the rupee, and also over the past 6 months there was a price rise in the world market. And another factor, the shipping costs increased and the global supply chain is disrupted. All these made imported natural rubber less attractive to the auto tire industry. And at the same time, domestic markets, in the domestic market, nearly 80% of the rubber is produced in the state of Kerala. In Kerala, this is a seasonal low supply period. So that is one reason. So these are the various factors which helped India to perform better. Means it helped the Indian market to be in the positive territory during the last week. We have one more slide, that is chart number 6. That is on latex market. Latex market, we have two important markets. One is Kuala Lumpur market, where the prices averaged 4.8% lower compared to a week before. And another important market is Bangkok, where the price averaged 3.6% lower compared to a week before. So these are the price review of the prices during last week. Now the next question, what can happen in the coming week? One important question I am always getting from people in the industry during the last 2-3 weeks is, oil price is going up. Then whenever oil price goes up, natural rubber price is supposed to go up. So this is a conventional belief among the investors. So they were expecting rubber price to explode, because oil price went up from below $90 to the level of $130, $135 over the past 2 or 3 weeks. So in fact, some of the industry people were expecting such an explosion in the case of natural rubber. So one important thing to note at this point is that when oil price increase, this is argument. When oil price increases, synthetic rubber, which is petroleum derived, became more expensive. So speculative investors think that those using synthetic rubber will switch over to natural rubber, and because of that, demand for natural rubber will go up. This is something like a belief among speculative investors in futures. One thing to be noted is that the substitution between natural rubber and synthetic rubber is very low, is a marginal. And the basic reason is that because of the certain functions, certain parameters only natural rubber can meet. Synthetic rubber is not a perfect substitute for natural rubber. So certain functions and certain special parameters synthetic rubber may not be able to meet. That also depends from product to product. So first of all, natural rubber is not a perfect substitute for natural rubber. And because of that, production managers in different companies, they won't allow large scale substitution or interchange between these two. They won't usually agree. So substitution is very much limited between these two. Number one. Number two, when natural rubber price goes up, it is giving a space for the synthetic rubber producers to revise up the price of synthetic rubber. So whenever natural rubber price goes up, automatically we can see the synthetic rubber price also going up, because the people in the synthetic rubber industry, the players are only limited. So they always use this as whenever NR price increases, they use that situation as an opportunity to revise up the synthetic rubber price. So that means the substitution, in that case, substitution may not be economically advantageous. And another thing, why oil price is going up now? It is not because of the heavy demand. Oil price goes up due to several reasons. One important reason, whenever, suppose economy is growing at a very fast rate, oil price goes up because of the heavy demand from a growing economy. In that case, that is a positive news to the natural rubber market also. So it means economy is expanding at a faster rate, oil demand is going up, and rubber demand, natural rubber demand will also go up in that way. But at the moment, we are concerned, investors and speculative market are concerned about, not about they are concerned about, they know that natural rubber price, synthetic rubber is becoming more expensive. But that need not translate into higher demand for natural rubber at the moment. At the moment, demand for natural rubber is way down because of the economic repercussions of the sanctions imposed on Russia, and also its potential implications on the auto sector. Auto sector is a major end user of natural rubber. So at the moment, what is dominating is the most dominating concern is the downward revision of the global demand due to the war, due to the economic sanction, and their economic impact on and their impact on the auto sector. That is a dominating concern. So because of that factor is at the moment dominating. So because of that, investors are not considering the potential switchover between NR and SR. That is one thing. So coming to that new week, in this week, we don't expect any positive news. The Russia-Ukraine tussle is continuing, and today also we haven't seen any progress, and we are seeing no end in sight means we are not seeing any positive sign of reaching what is called reaching some kind of understanding or ceasefire between the two countries. So that is continuing. So the demand concern arising from the Russia-Ukraine war, I mean NR demand concern, especially in the auto sector, will continue dominating the market sentiment in the coming week. So that is a negative news. Of course, we have the low supply because of the seasonal factor that is there, but that factor will be over dominated by the demand concern. And also we have several negative sentiment because at this moment of time, speculative investors will be keeping away from a risky investment. So they will be looking for safe havens of like a US dollar, gold, or some currencies like a Swiss franc, Japanese yen. So whenever the risk and uncertainties are dominating the market, that means speculative investors are likely to stay away from risky investments, including natural rubber. So we don't expect a rebound in natural rubber in the coming week. We expect rubber price to perform a sideways movement during the coming week. So this is something expected. Roughly, I can say whatever happened in the last week can continue in the coming week. Thank you very much.
That's about the rubber industry market review, focusing on the natural rubber market. I'd like to invite all of you to join this session on the NR dialogue, which is scheduled in this week on the 24th March. This actually NR dialogue is hosted by Mr. Jom Jacob, and we are on the episode number 3. This is focusing on the Latin America natural rubber industry. We have invited 3 experts from the Latin America to talk about the opportunities, developments, and the challenges with the natural rubber industry in Latin America. So I do encourage all of you to participate in this session on the 24th March. Okay. The time is going to be 10:30 Brazil time.